If you watch the close carefully, you could feel it. We've seen this playbook before: a dip into the close, a last-minute push to hold silver under a psychological level. This week, it was the attempt to pin price below 65. But something different happened. The buyers didn't hesitate. They didn't wait for a better price. They stepped in aggressively, lifted the offers, cleared the order book, and pushed silver higher right into the final bell. That kind of close tells you more than any headline ever could. It wasn't fear of a crash. It was fear of not owning enough. When a market closes on its highs like that, it means buyers don't care what they're paying anymore. They care about being positioned. They're looking ahead, not behind. They know the weekend is coming. They know the news cycle doesn't stop. And they don't want to wake up on Monday on the wrong side of the trade. Now put yourself in the position of a commercial short seller. You're a bank. You sold silver in the mid-60s, fully expecting a pullback. You plan to buy it back cheaper. Instead, the price is frozen on screens at 67.14 and the market is closed. You can't exit. You can't hedge. You can only watch. All weekend, the news keeps piling up. Rising geopolitical tension. Articles about battery supply. Constraints. Solar demand headlines spreading across social media. Every story adds pressure because you know the Asian markets are going to read the same headlines you are. If silver opens higher on Sunday night, your losses grow instantly. This is where the psychology turns dangerous. Risk managers don't sleep in moments like this. They start running scenarios. What happens if silver opens at 70? What happens if it gaps higher and never looks back? Can we survive that? If the answer is no, there's only one move left. Buy first, ask questions later. That's how gap and go opens happen. The fear builds over the weekend, then releases all at once when trading resumes. Not because people love silver, but because they're terrified of being trapped. There's a reason 67.14 matters. Below that level, the market spent months chopping around. Above it, the chart opens up. Go back decades and you'll see very little trading history up here. There are no old sellers waiting to get there. Money back. Everyone holding silver at these levels is already in profit. And people in profit don't panic sell. That removes overhead resistance. What's left is psychological. Round numbers. 70, 75. Those aren't walls. They're milestones in our heads. But excitement cuts both ways. Vertical moves attract tourists. Gamblers pile in with leverage, placing tight stops. If the banks manage to engineer even a small pullback, those leveraged positions get flushed out fast. That's how violent shakeouts happen. A correction doesn't change the trend. It tests conviction. Given the physical shortages we've been tracking, the recycling limits, the industrial demand, a crash would imply something structural changed. And nothing has. So while price action is telling one story, the real drama is happening behind closed doors. It's the weekend. Markets are technically shut. But the lights in Manhattan and London are still on. Inside risk departments, spreadsheets are glowing red. Short exposure is being examined line by line. Some positions don't survive the math. Margin calls don't always happen instantly for institutional money. They settle on variation margin. At the end of the day, losses are calculated. Cash must be wired. Friday's move wasn't routine. Some funds were leveraged, expecting a pullback that never came. By the time the bell rang, their losses exceeded available cash. On Saturday morning, phones start ringing. Credit limits are breached. Wires are demanded by Monday morning. If the money doesn't arrive, the position gets liquidated. Not because the thesis is wrong, because there's no cash. And liquidation for a short position means buying. Buying at any price. Buying until risk is zero. That's how forced buying enters the market. Now shift your focus from Wall Street to the physical side. Coin shops, online dealers, wholesalers. Imagine selling silver on Friday at 64, fully expecting to restock cheaper on Monday. Instead, the price jumps, premiums explode, and replacement inventory costs you $6 more per ounce. That's replacement. Risk. In a fast bull market, selling inventory can bankrupt you. So dealers freeze, websites go into maintenance. Sold out signs appear everywhere. Or prices are raised so high that buying becomes difficult. Not because demand disappeared, because sellers are scared. This creates a physical vacuum. Buyers rush in, sellers step back. And when that happens, the only way to bring supply back is higher prices. Above that sits the unallocated market. Paper claims on metal held by banks, most of it fractional. When prices surge and shortage rumors spread, wealthy clients ask a simple question. Do you actually have my silver? This weekend, quiet instructions are being sent. Convert unallocated to allocated. Put my name on a bar. Show me serial numbers. If the metal is there, fine. If it isn't, the bank has to go into the market and buy it. Immediately. At whatever price it takes. Because telling a billionaire, we don't have it, isn't an option. This internal scramble never shows up on a retail chart, but it's powerful. Banks end up bidding against each other to cover promises they already made. So ask yourself, when trading resumes, who's selling? Not miners. Not long-term holders. Not dealers who can't replace inventory. Forced buyers are lining up. Voluntary sellers are hiding. That's how gaps happen. Silver doesn't climb step by step. It jumps levels. It skips prices. And when it does, shorts don't even get the chance to exit cleanly. Meanwhile, the physical metal is moving. Ships, planes, armored trucks, flowing west to east. Drawn by price spreads that act like gravity wells. Silver trades higher in Shanghai than in New York, and metal follows price. Add direct procurement on top of that. Industrial giants bypassing futures markets entirely. Buying production at the mine gate. Locking up years of supply before it ever reaches public exchanges. The public market thinks silver is plentiful. The private market knows it isn't. That's why spot prices start to feel fictional. Try buying real metal at the screen price and see how fast you're laughed out of the room. Paper trades, physical disappears. Registered inventories keep falling. Delivery pressure rises. At some point, exchanges face a choice. Deliver metal they don't have or settle in cash and break confidence. That's the feedback loop no one wants to talk about. So heading into the open, the plan isn't panic, it's awareness. Watch the gap. Watch the retest. Don't chase, let price come to you. Volatility punishes emotion. Physical metal doesn't care about gaps. It doesn't get margin called, it waits. This isn't a story about a number on a screen. It's about a system under strain, a shift in flow. A change in behavior. The banks are having a difficult weekend. If you've done the work, you shouldn't be. This is legacy of money, where market psychology, physical reality, and history meet before the headlines catch up.